Hi everyone, and thank you for tuning into my channel where I talk about stocks, the stock market, and investing. In today's video, I'm going to answer the question if Peloton stock is a buy. I'm going to use my simplified 6-step framework for analysis, and before the video is finished, you will have your answer. Alright, so let's get right into it. The first step framework is the customer value. And Peloton sells expensive, I mean over $1,000 for exercise equipment, and you have to either pay cash up front or enter into an agreement that can take you several years to pay off your exercise equipment. That said, they do add convenience by allowing you to exercise at home without driving to the gym, looking for parking, and finding a machine, so there's perceived value there. Revenue has grown from 217 million in 2017 to 3.6 billion in its most recently completed fiscal year. So clearly there's a lot of people that find Peloton's offering to be a good value. Otherwise the revenue would not have exploded as it has. Now you might think that all of this revenue growth happened during the pandemic, and that's not true. Revenue was growing over 100% per year for Peloton even before the pandemic. Sure, it accelerated during the lockdown phases, but revenue was growing and it was extremely popular even before the outbreak. So that's a misconception of Peloton that it was exclusively a stay-at-home stock, which is not true. Unit economics, right now the company's revenue and expenses are all over the place. It's in complete disarray after overinvestment in capacity it made following the surge in sales during the pandemic. What happened during the pandemic, it experienced an absolute surge in sales volume, and it wasn't able to keep up with demand, and that persisted for several weeks. And so management, seeing this surge in demand, said, all right, let's invest in capacity so that we could build more of these products, so that we could sell more of these products. And by the time all of those capacities investments came online, sales growth slowed down and ultimately reversed. And so that was sales growth was reversing when gyms started reopening. Meanwhile, Peloton had all this extra capacity on its hands, and so now all of that is leading to massive increases in costs while sales are falling, and so that's leading to negative gross profit margin in its equipment segment. And so it's all messed up now, and the previous CEO resigned over these over investments and mismanagement or choices and took responsibility. So now the new CEO is trying to better align the business across the board, firing a lot of people, rearranging capacity, going to third party manufacturing completely instead of keeping it in house. So all of these changes are designed to bring the company into balance, but that remains to be seen whether they can achieve that balance again. So that's an ongoing process that's uncertain. For now, they're generating plenty of losses on the bottom line and also losses in gross profit. Still, the company's other segment, which is a monthly subscription. So when a customer buys a Peloton exercise bike, they also buy a subscription, which is $44 a month for live and recorded classes. That part of the business is extremely profitable, 70% gross profit margins. So that part of the business is extremely profitable. If Peloton can get the exercise equipment margin to at least break even or slightly above break even, then the subscription side of the business can deliver solid gross profit and fuel the profits for the business. But for now, the hardware side of the business is losing so much money that it's not enough to offset the profits that are coming in from the subscription side of the business. The total addressable market for the company, and I'm going off of what management said. The new CEO came in and said that he believes the company can get to 100 million subscribers long term. So that's a long runway from where they are right now, where they had 3 million subscribers as of its most recent update. So if they can manage to reignite growth, reinvigorate growth, they've got a long runway ahead. There's a lot of individuals in the world that exercise. There's a lot of individuals that subscribe to a gym. Not all of them will switch over to at-home exercising, but management believes that they can attract up to 100 million people to buy its product and subscribe to its services longer term. Competition for Peloton, they're competing with the traditional gyms, in-person exercise live classes, and typically those will cost an individual less money than a Peloton would. Peloton, you've got to pay $1,500, $2,000 up front for the equipment, and then on top of that, you got to pay $44 per month. A lot of gym memberships alone are less than $44 per month, and that's not even including the upfront cost that you got to pay for Peloton to get the bike in-house. And so that's a significant hurdle that Peloton needs to leap right there. And then secondly, there are other at-home exercise equipment products, and most of those products are priced lower than Peloton. Um, Peloton is the premium service provider. They have the most robust category of live and recorded exercise classes, and so they are the premium provider in the market. However, they're also priced in the premium space as well. Valuation is a difficult one to consider for Peloton because of its recent disruptions in the business and massive changes that are ongoing right now, and the big boost in sales it got during the pandemic, and now the retracement and the reflexivity, the mean reversion after that as gyms are reopening. So let's take it with a grain of salt here. The price to sales ratio is 0.885. The cheapest it's been going all the way back even before the outbreak. You haven't been able to buy Peloton at a lower price to sales ratio, but that's for good cause. The business has never been in as much trouble as it's in now. And so there's a reason for there's arguably justification for the lower valuation. Okay, the final step in my framework are risks. And for Peloton, the primary risk right now is its balance sheet, which is vulnerable with 1.25 billion in cash, but it generated a negative free cash flow of 412 million in its most recent quarter. And if you do the math here, it can only go on for 3 more quarters if it keeps burning 400 million each quarter. In 3 quarters, it'll run out of cash. So that's going to lead, it's going to either need to raise more cash, it's going to need to either borrow more money, or it's going to need to sell more stock, each of which is not a desired outcome. If it borrows more money, it's going to increase interest expenses. The company's already losing money on the bottom line. That's going to make it harder to achieve profitability. If it sells more stock, then that's going to dilute shareholders, each of which is not a desired outcome. So a primary risk here. And secondly is the worsening headwinds from economic reopening. Peloton got a big boost when gyms were closed and we were forced to look for other exercise options. Now that gyms have reopened, people are going back to gyms, and we don't know how long and how deep this pullback in sales will be for Peloton. Will people feel the need or the urge to leave their home because they were cooped up at home for the better part of 2 years and absolutely avoid getting a Peloton bike because they don't want to spend more time at home, um, exercising or not? They can look at it as going to the gym is an excuse to get out of the house, something they want to do more so than ever before because of spending so much time at home during the earlier phases of the pandemic. So this is an uncertainty, this is a risk, and investors of Peloton need to look out for this because we don't know how long this will go. All right, now that we've looked at each step in my framework, let's look at the grade that I gave Peloton in each step. For customer value, I gave Peloton a B. Even though it's expensive, it's on the premium side of the market. They are incredibly popular with consumers. They get a high brand loyalty score. They have really high customer retention rates, above 99% of their customers, their subscribers, renew their membership every month. So they're keeping and retaining a lot of their customers. They perceive a good value from them. So I gave Peloton a B here, despite the uh, expensive price and despite the other factors. I gave it a B because of their high customer retention rates and the excellent revenue growth. Unit economics, I gave Peloton a C minus here. The massive losses in their product, in their hardware segment, is not enough to offset the excellent margins in its subscription base. And so until they get that balance, until they offset enough of those costs and reduce enough of those costs to bring it in line, I'm going to give them a C minus here. Even though I will acknowledge that the CEO and management has acknowledged this in working on improving it, as it is right now, it's really bad. So I gave them a C minus. Total addressable market, I gave them a B. 100 million customer base is robust. And considering they only have 3 million right now, they have a long runway for growth. So I gave them a B there. Competition, I gave Peloton a C plus. They're adding convenience to customers by having, removing the need to go to the gym and, all the time that's required to go over there. But that value is not compelling enough to keep customers engaged right now while gyms are reopening. Millions of consumers are choosing to subscribe to a gym rather than to go with Peloton, because Peloton's offering is not compelling enough. They need to make it more compelling, either by lowering their costs enough to lower the price of their bikes and their monthly subscription, or by communicating the value to consumers to bring more consumers on board. Either way, they gotta improve their competitive position vis-a-vis the legacy providers. Risk, I also graded Peloton poorly. I gave them a C. High degree of risk here on the balance sheet. 400 million in cash, in negative free cash flow, when they only have 1.2 billion in cash on hand, is not a good sign. So I gave them a C there. Valuation, I gave them a B. Relatively speaking, they have never been cheaper, but that cheap valuation is justified because of all the other factors facing it right now. So I can't say that the stock is cheap by any means. We can't say it's inexpensive, but we can't say cheap. Okay, now that we've looked at each step in my framework and the grades they received, let's answer the question you've all been waiting for. Is Peloton stock a buy? It is not. Peloton stock is not a buy. The near-term risks are too high. The uncertainty in the business is too high. The sales decreasing from the hardware segment is too much of a headwind, and we don't know how far that's going to go. And so for all of those reasons, I would not recommend buying Peloton just yet. I would wait at least 1 or 2 more quarters and see the progress the company is able to make in bringing the costs down to meet this new level of customer demand for its hardware segment. Okay, so thank you for watching. Let me know what you think about Peloton in the comments section. I love reading those comments. I love to hear your perspective, so that's really interesting for me, and I'm sure it's interesting for all of the other viewers to hear your engagement in that regard. Okay, so thank you for watching. I'll see you next time in the next segment of Is This Stock a Buy?
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beat the market by more than 250%. Go to fool.com/Parkev to get your 10 stock picks now.